Hey guys, I want to record this video just to try to make WAC a little bit easier, help you understand it intuitively, and once you understand that, then you'll realize you don't actually need this formula. So what is WAC? So it's weighted average cost of capital. So what that means is how much does it cost for us to deploy capital, and how do we discount anything that comes from that? So let's say we want to build a factory. All right, the factory costs $1 billion. Now, how do we make sure? How do we see whether that the cash flows from that are going to pay it back? Well, you would essentially do a DCF, discounted cash flow model, and you would see. But one of the numbers you're left with that you don't have is the discount rate. So how do you know what discount rate to use? So you could use, let's say, the cost of your bonds, right? Okay, but that doesn't count for equity. You could use CAPM, but that doesn't count for bonds. So what you use here is a weighted average cost of capital. So any firm is going to have a capital structure. So its capital structure, it's how much debt do they have and how much equity they have. So those are the two types of capital that you could have. So this is our made-up firm. And let's say that that they have 10,000 shares outstanding, and each share is trading at $100. Okay, so the value of the equity of the firm is going to be $1 million. Now, let's also say that we have $1 million in debt. Right? We went to the bank, we got a loan, we borrowed $1 million. So our capital structure here is it's 50% equity, 50% debt. So our capital structure here is 50-50. All right. So we have at equity is 50% and debt is 50%. Okay. So let's come back to our formula here. Debt over debt plus equity. All that is the percentage of the capital structure that's debt. So we'll place that with 50%. And then we look and we say, okay, equity is going to be 50%. And the only two types of capital you can have are debt or equity. So these two are always going to add up to 100. So let's come back to this. Now, what else do we need? We need cost of debt, we need cost of equity, and then this 1 minus t. We'll get to that at the end, but cost of debt is simple. So let's say our bank loan, cost of debt, so the bank says, okay, we'll give you $1 million, you pay us 5% interest. Okay, so our cost of debt is 5%. Simple. So we bring that over here, times 5%. All right. Now cost of equity, up here. All right, well, you know how to do cost of equity. It's CAPM. So risk-free plus beta, risk of the market, minus risk-free. And let's say at the very end that equals 10%. All right, so now we have cost of equity at 10%. Now, the last piece we need to do here is 1 minus taxes. So we have this final term, 1 minus taxes. Now, why do we need that? So if we look at an income statement, right, you have revenue, you have your cost of goods sold, you have your gross profit, and then you have some expenses here, so let's say SG&A, just make it simple. All right, and then right here would be debt service. So this would be the interest on your debt. Down here, so right here is net income minus taxes, and then you get down to a final number here. and then minus dividends. So you think about it, right? Where do taxes come in? Taxes come in down here. So debt is paid out before taxes, and dividends is paid out after taxes. So what that means is it's actually cheaper to finance with debt here than it is with equity, because you get to write it off as an expense before your taxes. So they call that a tax shield, but I like to think about it as just we get a tax advantage here for taking out debt. So let's say this company tax rate, just to make this, the numbers really super simple, is 50%, all right? So 1 minus 50%. So what we have here is percentage debt times cost of debt with the tax advantage, plus percentage equity times cost of equity, and then all we need to do is just solve. So 2.5% times 0.5 plus 50% plus 5%, 6.25% is going to be your WACC. So one final note in calculating WACC is sometimes instead of it being a bank loan, it's in bonds. So how do you figure out the cost of debt for bonds? Well, you got two numbers that you usually know, or you usually know one and you can calculate the other. So if you know yield to maturity, you're using, because yield to maturity is your cost of debt. If you have the coupon, which is not necessarily equal to the yield, then you need to use the yield to maturity function, or yield to maturity equation, to get from the coupon rate to yield to maturity. So by using yield to maturity, then you can know cost of debt. When you know cost of debt, you can plug that in here, and you make the whole equation work. So let's recap. What I said at the beginning was that even though this equation is long and complicated, it's actually really intuitive and you don't actually need to memorize it. So if you say weighted average cost of capital, weighted average, so the percent debt, percent equity, cost of capital, cost of debt, cost of equity, and then the only thing you have to remember that's not intuitive is this 1 minus taxes. And you can remember that by looking at where debt comes out on an income statement. It's before taxes, so that means it's cheaper, and you multiply it by 1 minus taxes.